Hey everybody, I'm Joe Pizar and welcome to our quarterly economic update. I'm joined with my partners Melissa and Josh Stein, and guys, it has been a busy couple of months since we talked to everybody, so we wanted to bring a brief economic update along with some tips and tactics you might want to consider this year as we round out 2022. So economic indicators that kind of show what's changing over the past few months here in the market, and as of July we can see that a lot of these indicators have dipped into the yellow area and even into the red for some of them. So those being monetary policy, interest rates, geopolitical risk, and inflation. As we look at what's changed since December of 21, you can see that inflation number, interest rate, geopolitical, corporate profit growth, and our consumer spending numbers have been affected. What are you hearing and seeing from?
Start to rewind back to earlier this year. Beginning in January, things were actually looking reasonably good. Inflation numbers hadn't started to really get too far out of whack. Corporate profitability was strong. We were still kind of riding this wave of positive economic results. And then things started to kind of break up a little bit. The number one problem that has just kind of been a significant weight on everything is, no surprise, it's inflation. And we started to kind of get a mean wake-up call for the economy and for the stock market when inflation numbers started to get out of control. You had mentioned moments ago that monetary policy has become a risk to the economy and to the markets, and that one has really just been exacerbated more than anything when it comes to inflation, because the Fed has really been, in my opinion, not too great at combating inflation. We could spend hours talking about that, and we won't. But to make a long story short, I think the Fed's actions over the last 6 months have only really made things worse for inflation, for the economy, but it's been a tough battle for
Well, and in some ways, really the stock market as well, because as we know, the stock market likes uncertainty more than anything, and the Fed has been, they haven't been exactly clear about what the strategy is here. We seem to be in some uncharted territory from the standpoint of, how they're managing their balance sheet and other things. So, the markets tend to overreact generally when information like that is coming out. And when you pair that with other things like geopolitical risks, further supply chain stuff, that's kind of how we arrived at today.
Cool. So we've seen today the Fed took a 75 basis point increase to the Fed funds rate. The chart that you're seeing now will explain kind of what is going on with their balance sheet, though. So we've been seeing a lot with that federal funds rate, but what is the balance sheet of the Fed, and what do we see as they're tapering off this quantitative easing and the spending that happened during COVID?
Well, from a simplicity standpoint, the Fed's doing what they feel they need to do to basically slow down spending. We think about raising interest rates as the way to combat inflation because that's what the Fed has mostly been talking about, but that's not their only tool in the toolbox. In fact, that's probably not the only solution, and if the Fed only does that, we're likely not going to see a decrease in inflation. We got to go back to why we're seeing inflation. We're seeing inflation for one reason and one reason only, and it's because we've seen more money enter what's called the M2 money supply, which is spendable dollars, money that you can go and buy groceries with or buy gas with. We've had more of that dropped into our economy than we've ever seen in the history of modern economics. There's just too much money saturated in the economy. How do you get rid of it? You have to basically let it bleed out. Raising rates
it has to get absorbed.
It has to get absorbed, exactly. Raising rates is one way to do that. How the Fed manages their balance sheet in terms of how they buy and sell bonds is another way. How they also make banks regulate how they can lend money is another way. Bank reserves and managing bank reserves all go into how easily money is able to essentially get absorbed out of the economy. And right now, that's what they're trying to do. So yes, the Fed just moments ago raised rates another 75 basis points. That's the second time in a row it's been 0.75. I think some people were a little concerned maybe they'd come out even higher, 1%.
Well, that's actually a perfect segue into, I think, our next subject, which is really helping people understand like what this bear market means to them, and in particular inflation. That really hits home, I think, with everybody. I think right now that this bear market seems really scary to most of our clients, and just I think investors in general, because one, it's been a long time since we've really had a bear market like this. It's been significant. I mean, we just have gotten used to enjoying only the upside potential of the market, and we do know for every 10 years there's usually 7 good years and 3 bad years. I think over the last 15 years has been a lot more good years than bad years, number one. Number two, we're coming off of a pandemic, which I think has been emotionally and physically exhausting for pretty much everyone. And now coming out of that, it's really discouraging to not only see your net worth decreasing, but then because you're watching your accounts go down, right, from this bear market or this market correction, whatever you want to call it. But you're also then seeing prices increase at the gas pump, at the grocery store. I mean, everybody is talking about that. And so, the reality is that this really is hitting home with people, but I think it's causing many of us as investors to react emotionally and maybe even overreact to this bear market. And I know we sent out a piece a little while ago that just kind of putting things into perspective, but this is not an out of ordinary bear market. It's actually, at least here, and what we know as financial advisors, it's actually a very kind of expected situation. I think S&P was down at one point, like 22 or 23% at worst. I think maybe down 18. Now we've recovered some of that.
Considerably.
From a magnitude standpoint, I mean, that bear market is very normal. We also know bear markets on average last about 9.6 months, which might be good news for us, because if that's the case, then we're probably like 7 months into it. So what we want to focus on in some of these talks isn't just kind of like what's happening, because I think a lot of us know what's happening, and maybe not even like our opinion, but what can we actually do to make lemonade out of lemons? And not only that, like there are actual real tangible strategies that we can implement right now with our clients, no matter what sort of life stage they're in, to help them not only weather this storm, but benefit.
So, and this is perfect, Melissa, and thank you so much. So, for their money. So let's break it out into our accumulators and our distributors. So maybe those saving for a goal, probably retirement, and those either transitioning into, and those, it's a very critical group right there, transitioning into that distribution phase, or those that are already well into retirement or distribution. So for your accumulators, what are you guys talking about? What are we seeing come up in meetings? What's the hot point for our accumulators?
Okay, well, I'm just going to sort of give some perspective. At least, I talk to a lot of people. I kind of try to get the pulse of like what people are thinking. And when you say accumulators, I'll define that. So for those of you who are clients or not clients who are still accumulating wealth to work towards retirement, say you're at least 5 years, maybe 10 years or more away from retirement, this can actually be a tremendous opportunity for you. I mean, somebody said something to me the other day. I won't take credit for it, but it's a really good quote. He said, the stock market is the only investment that people run away from when it's on sale. And it's actually just so true. And the reality is, as smart people, and most of us are, we know that we should always buy something low and sell it high. But because of our emotions, like especially right now with this bear market, oftentimes we have sort of the opposite instinct, which is to run away from saving right now, or take our money out of the stock market right now, or leave our cash sitting on the sidelines. And the way that we can take advantage of a market like this is to very conservatively continue to save, because we want to buy assets when they're low. And that means that if we can do that today, even if there's a little bit more pain or it gets a little bit worse before it gets better, historically, there's a lot of really very high quality stocks on sale right now. And bonds too. I mean, bonds, we're not just talking about the stock market. I mean, the bond market's been down as well. So for those of you asking questions to yourself, like, should I keep putting money in my Roth? I have this cash, should I get it invested? I mean, our answer would be absolutely. Are there ways to go about doing that to make sure that that you're not exposing yourself to all of the market timing risks, like dollar cost averaging, which means like putting in different amounts at different times? Absolutely. But that's how you make lemonade out of lemons. And if you are further away from retirement, you don't really need to worry about how long it's going to take to recover from that, because we know historically we're going to see probably a pretty big surge after this correction. One way is to continue saving. Another way is to realize that if you have cash on the sidelines, whether it be from an inheritance or you just had extra cash or like there's found money, this could be a really good time for you to enter the market no matter what point you're at.
Maybe even play some catch up if you need to, if your probabilities aren't quite where you want them. So that's great. Josh, can you talk a little bit about some of the portfolio things as far as rebalancing and things we might be considering now in this market? I mean, we always hear like systematic rebalancing, but it's a pretty deep contraction thus far. So what do you think about rebalancing and all that?
Well, we generally rebalance regardless of what the markets are doing, or at least make what we call timely and tactical decisions. We may not be doing a traditional rebalance where we're selling everything that's up and buying everything that's down. Sometimes we're a little bit more specific about what we're buying and selling, but to us, whether the markets are up or the markets are down, there's always some work to be done, or at least there's opportunities to be found. The most important thing to us, though, is to not try to time the markets, because that doesn't fit into our general investment philosophies. But what we do try to do is be reasonably tactical when it comes to where we want to take risks. Yeah. And right now, we're probably more defensive than we've been in the past. Some asset classes, we just don't want to take maybe the full risk on right now. Bonds in particular, many of our bond portfolios, we've reduced our exposure to certain types of bonds simply because for the amount of interest that they're kicking off, which is low, and relative to how much risk they have as rates increase, we don't necessarily want to have a full allocation towards bonds. So we've utilized other alternative investments that tend to be as they look like bonds on paper, they feel like a bond in terms
similar
of
risk profile,
but they're not subject to the same interest rate risk and the same pressures. We're going more towards quality. So in the past and in the recent past, it's been all about growth. It's been all about tech. It's been all about having growth opportunities in stocks, and that we've seen a reversion more towards quality, more towards well-capitalized companies, dividend-paying companies, and we've made some adjustments over the course of many months to start to allocate towards some of those value companies, some of those more quality companies, without just abandoning growth also, because we don't want to just sell everything and walk away, in particular when it's down. Like you said, you want to buy low, sell high. You don't want to necessarily sell everything when it's low if you have conviction that these things shall pass.
That's great.
So we have increased a lot of our exposure to dividend-paying companies, etc.
Well, and that really just dovetails, it ties in with what I was saying earlier about even if we go into a recession, which we're not technically in yet, at least as of right this moment. I mean, maybe we are and we don't know it, but there are going to be companies that still come out of that and fare well. And as long as you're invested in those companies, it's okay that they've gone down temporarily. I mean, it's just part of investing. And that's why value stocks, dividend-bearing stocks, they make a whole lot of sense right now, because we know that they're going to be the least impacted by a rocky economic situation. They're not, Amazon's not going out of business tomorrow.
You brought up great points there, Mick. And like you said, there's a little opportunity showing up, and I know that we're getting long in the tooth as far as, our tenure in the career. We're almost, 20 years in. So we've seen a pretty low interest rate environment for most of our career. A little bit easier to make that dividend yield that the client needs when the interest rates are up, right? We're not going to be as reliant as portfolio managers on equities as much moving into this environment. So I think there is plenty of opportunity out there for these investors and for us to build, more bomb-proof portfolios to get them through it. So like you said, with every economic environment, there's something that will become an opportunity, and I think that we're identifying those really well. So good points for the both of you. What else are you talking to clients about? Distributors. What are our retirees doing right now that are helping them bolster their position?
Well, I'm really glad you brought that up, because we're getting a lot of different questions from retirees than we are from our clients who are accumulating, and they make total sense. I mean, first of all, naturally, anyone who is near retirement or in retirement is very concerned, because, I always hear them say the same thing over and over again. They always say to me, well, I don't have time to recover from this. Am I still going to be okay? How do I make the best of this situation? Do we need to be making any changes? I mean, and there are answers to all of those questions. I mean, first of all, for our clients, and what everyone should know is if you have a sound financial strategy in place, like projections you do with another advisor or with us. I know what we do. For our clients, you probably just, if you walk away with anything from our meeting, it's probably that probability of success number. This type of market absolutely should already have been baked into the plan. And so whatever the investments are experiencing at this time, it's okay in a normal part of the process for them to go down. There are ways that we mitigate those risks and that you can if you are distributing. I'll list a couple of them, and I won't get into a lot of details, but number one, now we do this for our clients automatically, and we have a set of decision rules that we make, but the most important thing is not to draw off the wrong assets from a portfolio in a declining market that persists for a long time. I mean, it makes sense. Think about it. If you have a portfolio, it's $1 million, you're taking out $40,000, it's a 4% withdrawal rate. That's what we consider to be like a safe withdrawal rate, like 3 to 4%. And that $1 million becomes $800,000. Is 40,000 of 800,000 still 4%? No. Then what happens is your withdrawal rate starts to creep up. You keep selling assets that are down, which is the opposite of buy low, sell high. It's sell low, and you end up having to buy high later. You don't have anything else to buy back in. And what that can do is permanently damage the portfolio. We have ways to combat that here. Number one, that's why we make sure our clients have cash reserves. In extreme situations, we might not take out of the portfolio at all. Number two, we can switch from selling stocks to bonds or bonds to stocks or alternatives, or in this case, the hedge strategies that we put in place, the funds that we put in place to hedge the stock and bond risk, which are basically the ones that are up. Those are the ones we're going to draw from first. So that's a really, really important concept when having a distribution strategy. Two is you should delay, if possible, or finance large expenses. Had a client call in the other day, needed $150,000 for something. We decided to use a margin loan or home equity instead of just liquidating the assets, because right now it's just not a good time to do that. I had another client who's
It doesn't mean we can't do that later.
No, and of course, like there's strategies for implementing that. But I had another client who said, well, I wanted to do my bathroom this year. It's going to cost me, $35,000 to redo these 2 bathrooms. But you know what? I don't really need to do it right now. I'm just going to wait till next year. Yeah. If you can do that and it's not a big deal, I would suggest delaying large withdrawals from your portfolio that are unnecessary at this time, or let's figure out a creative way to still fund the goal, not have to, sell the assets. It's not that they can't do it. It's liquid. It's just really not the best timing from that perspective.
That's really good, Mel. Thank you. Josh, what are you seeing pop up real quick? What are you thinking? What are you looking at for folks?
Well, Melissa, you brought up a lot of really good points, and one of those being perspective, and in particular with the financial planning that we do. We actually model what we call a bear market simulation or a bad timing test, and those models are specifically designed to identify economic periods just like this and what the impact of your probability of success is. The goal would be to be able to overcome a significantly down market. If history repeats itself, which going back to the 1930s it always has, the markets always come back. The average recession lasts about 13 months. As you mentioned, the average bear market lasts actually less than that. And in fact, the difference between the bottom of the markets and when a recession ends is about that 4 to 5 month period. Where are we in that now? It's really hard to say. It's likely that we could be looking at the tail end of this, but only time will tell. What I think clients like to know is, do we feel that it's going to be different this time? Nothing in my mind leads me to believe, or leads us to believe, that this will be a different outcome than what we've seen through normal market cycles. And when I mean normal, I mean they go down and they go up, and then eventually they go back down and then they go up, but they always go up more than they go down. Mm-hmm. As you said, 7 good with 3 bad. You got to take the 3 bad to get the 7 good. I don't see any reason why we would expect anything different this time. But it always feels different.
Well, the circumstances are always different, but the fundamentals of the economic expansion and contraction of the economy, and just the way that the stock market behaves. I mean, statistically, most things fall back into the averages.
It's really good.
And they behave that way. But once again, I think there's two other things. I mean, a really charged political environment, sort of some like mental exhaustion from the pandemic and just all of that, and then the inflation, and then even some of the geopolitical things that are happening, like Russia and Ukraine, is causing us to feel like it's more emotional. And I hate to say this, and I don't want to minimize the importance of those events, because they are really important, impactful, but the economy and the stock market are very resilient. They find ways to work around these things. We actually see very little like long-term correlation between, for example, like whatever political party's in control or
War.
what's happening, you know, in Russia and Ukraine. I mean, those things don't impact the market and the economy as much as we think. It eventually adjusts and works around it. So, you know, Joe, one other thing we were talking about earlier that maybe you want to touch on is as another strategy that the client should really be thinking about is managing debt and the variable interest rates that are sort of, you know, affecting people now.
Yeah, so as we're all looking at these expenses, I think it's absolutely critical, especially as we see Fed funds rates go up another 30 or 3/4 of a point today, really cleaning up that variable rate debt.
Credit cards.
Yeah, what do you mean by
example of
that?
that would be
Yeah.
like a credit card, a home equity line of credits are typically variable. Maybe your businesses that have lines of credit to pay their
Right.
salary, etc. So just being cognizant of what you're paying, because perhaps you didn't pay attention to that line of credit for some time, and
Yeah.
now that rate might be floating up.
When
So
rates were low, interest was nominal. Now it could
free debt.
potentially be
It was a
lot
free
more.
debt
Yeah.
environment for a long time. So.
Well, but I see that most impactful, at least for my clients, with mortgages. I have a lot of clients who I said, you guys should refinance. They said, no, I don't want to really do it right now. Well, rates went from like 2% to what, 6 very quickly. So if someone does have a variable rate, like home equity line of credit, they have an opportunity to convert that to a fixed rate home equity loan. There's a lot of people who don't understand the differences between those. We can talk more about that. And you know, those are definitely opportunities that people should be doing right now. It's not really going to get any lower than this. I don't think we're going to be in the same interest rate environment for the next 20 years that we have been for the past 30 years. Now, conversely, people should start paying more attention to interest rates on high yield money markets and stuff, because those should be starting to increase. And I mean, one of the positives is with interest rates increasing, there should be more risk-free assets
Look at that.
that
icon
clients
that came
can
out.
use to grow their cash reserves. And, you know, those are suggestions we make too for clients. So CD rates, money market rates, all of that stuff.
those are
So, okay. So in closing, just to sort of think about everything we talked about today, I think number one is we reviewed a little bit of what's going on in just the macro environment, just what's happening in the economy, the inflation, Fed policy, all that. None of that's really changed. We're just sort of giving an update on
And
that.
none of that's in
here-
anybody's control either, and I think that's a key.
And here's the truth. We don't really know how far we are into this bear market, how long it's going to take to recover. I think in many ways we're in uncharted territory with Fed policy. So, you know, a lot of economists are saying, well, it could be like 12 to 36 months before this resolves. All we know is it took a long time and a lot of money and a lot of stimulus to get here. It's probably going to take a while to unravel. I think that's probably just a fair conclusion. However, the most important thing in my mind is number one is if you are accumulating money towards retirement or any other goals, this is the time to absolutely be saving. It's a time to be getting cash off the sidelines conservatively and carefully with a well thought out plan.
Extra cash.
Yes, not your cash reserve. And there are good potential opportunities right now. From our, you know, point of view, everything's on sale. If you're retired, if you had a sound financial plan in the first place, I hope, and you shouldn't be panicking. That's at least for all of our clients. If you don't have a sound financial plan in place, maybe now is time to be thinking about getting one. That way you know that your particular, you know, portfolio and your scenarios are stress tested for these. But there's also always going to be a next time. So making sure you're managing your withdrawals properly, making sure that you're managing your risk in your portfolio properly in the first place, and making sure you have an adequate cash reserve. And then the last two things we talked about is looking at any debt you have, locking in anything that is a variable rate to maybe a fixed, because those rates could just continue to go up, and evaluating what that might mean to you. And then lastly, making sure you're maximizing, I think, the yield on your cash reserves. Now would be the time, if you've had $100,000 sitting around in your bank account. I won't mention any other local banks around here that are yielding like 0.01%. There are probably other opportunities to be doing that. Oh, and don't forget about the I-bonds. We sent out an email about that. I-bonds are paying, like, I think over 9.5% or so. I mean, you can only do $10,000 a year per social security number, but hey, I mean, where else are you going to get basically a 10% return?
Inflation adjusted too.
You know,
Just maybe a
anyway,
very
these are all very
short-term
specific
rate.
things, but we want you as our clients to know that we are taking into account all of these risks and working through your financial plan. We are not panicking about this market because it is really just part of the deal. And if you're really new to some of these strategies, I mean, there are really ways to make the best of a bear market. So
Well said.
thanks for listening today. I had a really good time talking with Josh and Joe. If you have any questions, you can always feel free to call us, email us. And I know that we're also trying to increase some of our subscriber awareness. So if you do think this would be interesting to someone else, please like it, share it, forward it to somebody else. We'd appreciate that.
As Joe says, like, share, and subscribe.
That's right. We'll see you guys next time. Thanks.
What can we actually do? Sorry about that. But
We're
what,
keeping that.
Yeah. What?